Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
So we're opening today on an asset that is really the perfect storm of operational distress and some very strange structural market dislocation. We're talking about Cracker Barrel, of course, CBRL. The price action here has just been unrelenting. It's shed what? About 46% of its market cap over the last 12 months. And it's trading near lows we really haven't seen since, the 2009 financial crisis.
And I'd argue that price action, which recently dipped below $30 a share, is completely and totally justified by the catastrophic deterioration we're seeing in the fundamentals.
I see why you'd say that, and the financial pain is obvious, but I think I'd frame the current risk profile a little differently. I think the central question for us is this. Is the immediate fate of CBRL's equity being dictated by this acute operational collapse, what you're calling a fundamental value trap? Or is it being dictated by the extreme, frankly, anomalous market structure and the mechanical risk of a liquidity squeeze, which is what I see as a technical powder keg?
And I'm going to maintain that the sheer gravity of the company's financial failure is going to overpower any kind of temporary technical bounce.
Well, my argument really focuses on the geometry of the trade itself. I believe the technical structure and the incredibly crowded short interest are the primary forces here. They're what's driving the near-term volatility and risk. The stock is, I think, primed for a violent move to the upside just due to mechanical factors that operate, frankly, independent of the current dire fundamentals. The short position is just too crowded. A squeeze is almost inevitable if there's any kind of catalyst.
That sounds more like a technical prayer than a structured trade. I mean, what evidence do you actually have for this imminent squeeze, beyond just a generalized hope for some momentum?
The evidence is right there in the data on the short book. The short interest is aggressively high. It's hovering somewhere between 22.9% and 24.26% of the free float. That's roughly 5.11 million shares on the short side. I mean, when a trade gets that crowded, the risk of a forced covering event just skyrockets.
But the metric that truly defines the risk here, given the stock's, often low daily trading volume, we're talking often less than 1 million shares, is the days to cover ratio,
which is at 9.49 days. So shorts need nearly 2 full weeks of average volume just to get out safely.
Exactly. And that DTC ratio is a classic indicator of volatility risk. If the company were to announce a new CEO, or even just a quarter that was, merely stable, the pressure on those 5 million shares to cover would be absolutely enormous. It would create a massive vacuum in liquidity. They are betting on the ultimate trajectory here, which is failure. They believe the catalyst they're waiting for is bad news, not good.
But you're missing the anomaly that makes this whole situation unique, what's called the phantom float. This is the real core of the technical powder keg. Institutional ownership data, it consistently shows holdings somewhere between 116% and almost 124% of the total outstanding shares. How is that even possible?
Share lending and rehypothecation.
Exactly. Aggressive share lending, mostly by passive institutional funds like BlackRock and Vanguard, allows the same underlying shares to be counted multiple times. This means that the real, tradable float available for actual buyers is, for all intents and purposes, zero, or maybe even negative. And when the supply of shares available to purchase dries up like that, any forced demand like short covering is going to push the price up vertically. This structure dictates that any positive news, no matter how small, triggers a mechanical short squeeze up toward the $40 or even $50 range.
That is a compelling argument about the mechanical risk, sure, but I'm arguing that betting on that squeeze is betting against an increasingly high probability of just fundamental failure. The stock's depressed price is wholly justified by this accelerating operational decay and the structural damage that's been done to the brand. Any kind of technical rally is going to be temporary and, frankly, a dangerous value trap.
Okay, so walk us through the gravity that you see pulling this price down, especially given the most recent financial results.
Look at the acceleration of the decay. The Q1 2026 results were catastrophic, and they confirm the severity of this crisis. Revenue contracted 5.7% year over year to $797.2 million. But the crucial point here is the erosion of traffic and profitability. It's infecting both parts of the business. Comparable restaurant sales declined 4.7%, which is really worrying because that implies a high single-digit traffic decline once you account for menu price increases. And the retail sales, the high-margin segment that historically made Cracker Barrel unique, they plummeted 8.5%.
And that collapse of the high-margin retail side just confirms that the customer base is simply not engaging with the concept anymore.
And that lack of engagement leads directly to the core driver of the entire bearish thesis, the massive leverage and liquidity concerns caused by the profitability collapse. Adjusted EBITDA fell by a staggering 84%. It went from $45.8 million down to just $7.2 million in a single quarter. When a mature company's cash flow generation dries up that quickly, you go from being a stable dividend payer to a high-risk turnaround story overnight. The market cannot and it should not ignore that.
And you attribute this not just to general market conditions, but specifically to decisions made at the top?
Precisely. This is, at its heart, a governance crisis. The strategic transformation plan under CEO Julie Masino, which was supposed to modernize the brand, it resulted in massive operational failure, inconsistent food quality for one. But the real inflection point was that disastrous rebranding controversy in August of 2025. That misstep showed a deep, deep disconnection from their core loyal customer base. Her admission later that she felt fired by America, that directly correlates with a reported 9% plunge in traffic. So, a valuation of 9.0x EBITDA might look cheap on a spreadsheet, but it's the definition of a value trap. Because the denominator, the EBITDA, is collapsing faster than the stock price.
That is a dire picture of the operations it's hard to refute. But let's bridge the gap between that operational failure and the mechanism of the short position. You claimed the short interest really picked up after the rebrand.
Yes, absolutely. Let's look at the timeline. The short selling didn't just accumulate steadily. It accelerated markedly after that August rebranding mess and the evidence of permanent traffic loss. This proves the short thesis evolved. I mean, it probably started as a technical bet against the company's ability to manage its upcoming debt, but it transformed into a fundamental bet against the brand's actual survival. The shorts saw the vulnerability and they piled on aggressively, pushing that short interest over 24%.
That's a key observation, the short motivation. But while the fundamentals provided the rationale for them to jump in, the structural risk is still the key constraint. The short sellers might have been attracted by the brand's struggle, but now I'd argue they're trapped. They're locked into this high-stakes bet against a liquidity event, and it's all governed by the scarcity of the float, the passive complicity by major institutions, which just keep lending out shares that are being double-counted. That's what keeps the float scarce and the squeeze risk acutely high. They aren't just betting on poor performance anymore. Their betting management fails to navigate this looming debt wall cleanly.
And that debt wall is the true financial gravity well here.
It is. The $149.4 million of 0.625% convertible senior notes that mature in June 2026. That could be the primary catalyst for the squeeze I'm talking about. The short thesis really hinges on the company being forced to dilute shareholders or face severe difficulty repaying that principal. If management can successfully refinance this debt using their available $485 million revolver and do it without a dilutive equity issuance, the immediate payoff for the shorts just disappears. And that simple act of debt management would trigger mechanical covering.
I'm sorry, I just don't buy that refinancing solves the core problem. The economic cost of this maneuver is fundamentally destructive to their profit path. I mean, yes, mathematically, they can pay the debt. The revolver is there. But they are replacing $150 million of incredibly cheap 0.625% debt with debt that's likely going to cost them between 7 and 9% in this interest rate environment.
That is a substantial increase in financing costs.
A crippling increase. That shift creates an incremental expense of roughly $11 million a year in interest payments. Now, put that in context. The company just posted a $24.6 million GAAP net loss. Adding another $11 million in annual interest expense makes any clear return to profitability in fiscal 2027 nearly impossible. This isn't a blip. It's a permanent reduction in future cash flow. It argues against the long-term viability of the equity at any price above, say, $20.
That $11 million interest hike is damaging, yes. But doesn't that critique assume they're operating for robust profit instead of just survival? Let's turn to the other distressed moves management is making, the covenant restructuring and that dividend.
The covenant restructuring is Exhibit A for a company in severe distress. In December 2025, management amended its credit agreement. They changed the metric from a consolidated total leverage ratio, which includes all their debt, to a consolidated senior leverage ratio, which artificially excludes the upcoming convertible notes. They did this because their total leverage was approaching 2.8x, which is perilously close to the assumed 3.0x limit. They essentially moved the goalpost to avoid a technical default caused by the 84% EBITDA collapse. That is not stability. That's financial engineering of the most desperate kind.
And the dividend currently yielding 3.34%.
It is highly suspect. They are paying that dividend out of debt, not out of free cash flow. Suspending it would be the fiscally prudent thing to do. It would save them, $22 to $25 million a quarter? But management is clearly paralyzed, afraid that cutting the dividend would lead to total investor capitulation. Doesn't this pattern, the covenant games, the unsustainable dividend, suggest the company is much closer to a liquidity spiral leading to prices in the $8 to $15 range? I think the shorts are playing for a Bed Bath & Beyond outcome here.
I'm not convinced, because you're ignoring the hard floor. The existence of significant real estate assets provides a tangible cushion. It prevents a true collapse into the single digits, unlike a pure retailer that leases everything. And while the argument that real estate doesn't pay the interest is true, some estimates suggest the liquidation value of their own properties could be worth $50 to $70 per share. That provides collateral and keeps the equity from going to zero. So the dividend risk is priced in, the underlying asset value makes the equity, even at $31.22, technically cheap on a liquidation basis, even if cash flows are negative right now.
But real estate is only valuable if you can monetize it without destroying your operating model. And let's look at relative valuation, because this shows just how fundamentally broken CBRL is.
Okay, please do.
The comparison to peers is just stark. Texas Roadhouse, a competent operator, is trading at a premium 26.9x forward PE. That shows the casual dining sector is fine for those who execute. CBRL, though, is hemorrhaging market share. The market views it more like a distressed asset, like Blooming Brands at 7.7x PE. This isn't cyclical weakness, it's fundamental, brand-specific failure, confirmed by that disastrous rebranding, which proved leadership is completely alienated from their customers. The market has correctly labeled this stock uninvestable.
Look, I absolutely acknowledge the fundamental alienation. The operational failures were severe. But here's the technical opportunity. The intensity of the social media critique and the uniform analyst consensus suggests we've reached peak negativity. The average street price target right now is $31.22, almost exactly where the stock is trading.
So zero implied upside. That just confirms the bearish consensus.
Precisely. And in a mechanically volatile stock with 9.49 days to cover, that consensus hold-sell rating and this extremely high short interest creates the perfect contrarian opportunity. The market is complacent. It believes the debt failure is inevitable. But when the short base is this crowded and institutional ownership is this convoluted, that phantom float at 124%, the technical pressure from any governance change or minor operational improvement will override those fundamentals in the near term. It'll generate that violent mechanical spike. The technical structure is the only thing that matters right now.
I just don't see the operational improvement materializing fast enough to save this debt-riddled ship from sinking into the lower 20s, especially with that high cost of refinancing looming.
We have covered a lot of ground today, moving from the operational crisis exposed by that catastrophic 84% EBITDA collapse to the highly unusual, very restrictive technical structure of the float.
And my analysis remains rooted in the reality of those accelerating operational failures. The negative fundamental trajectory, combined with the costly debt refinancing and the desperate financial maneuvering, it just makes this asset structurally high risk. Without immediate definitive governance change, CBRL is a speculative sell, and it's trapping investors who are mistaking low multiples for actual value.
And I'll reiterate that the technical risks, specifically the phantom float and that extremely high 9.49 days to cover ratio, they create an unavoidable volatility constraint. The investment thesis, for me, relies entirely on the mechanical squeeze potential, that spike to $40 or $50 that governs the near-term price, not the long-term fundamentals, which are clearly compromised.
So the material leaves the prudent investor to weigh the near-term risk of a high volatility short squeeze against the overwhelming gravity of a sustained financial and operational collapse.
Indeed, the entire debate hinges on whether market structure can, even temporarily, overpower the gravity of financial distress. Thank you for analyzing this with me today.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.